You are listening to C-Suite Perspectives, a podcast by the Conference Board.
Welcome to C-Suite Perspectives, a signature series by the Conference Board. I'm Erin McLaughlin, a senior economist in the Economy, Strategy, and Finance Center, and guest host of today's episode. Joining me today is our chief economist, Dana Peterson. And in today's conversation, we'll discuss the latest U.S. Consumer Confidence Index as well as trade. We'll start off talking with Dana about the CCI, and then we'll turn the tables. So Dana, were U.S. consumers more or less confident in January?
Consumers were a lot less confident in January than they were in December. And December, we did have somewhat of an upward revision. And so the delta was quite large from the 2 months.
And so does this match the larger trend over the last few months?
Consumer confidence has actually been falling since July. And that was after a little bit of a pickup following the drop we saw on Liberation Day in April of 2025. So on balance, over the course of 2025 and even into the first month of this year, consumer confidence has been trending downward.
Okay. Now, besides Liberation Day, the other big sort of moment this past fall was the federal government shutdown. How has confidence been impacted around that?
We saw it very clearly in November, where the respondents were much more pessimistic in November while the shutdown was going on, but less pessimistic. And you could even say somewhat a little bit more optimistic in the latter half of November after the shutdown, because the shutdown kind of split November. So we did see different behaviors, and we did note that in the November release.
Okay. Let's dive into some of the details of the report. Were there any notable differences in confidence by demographic group?
So actually in January, there really were no differences across incomes, age groups, even political affiliation, and even generations, because a lot of people like to compare generations.
Right.
All of those measures dipped or fell in January.
Okay. Now, what are consumers saying about the present situation?
Yes, consumers are saying that the present situation is worse in January relative to December. Indeed, they're more concerned about business conditions as well as the current labor market. And between those two measures, the labor market differential, which is the difference between people saying that jobs are plentiful versus hard to get, dropped. That was the bigger drop relative to business conditions currently. And that makes sense because companies are not hiring. And that's because over the last year or so, they have been very preoccupied with uncertainty. And amid an environment of uncertainty, companies are less likely to make big moves like hiring or firing. And the firing has been limited as well because there's still labor shortages.
That low hire, low fire sentiment that we've heard about. And so, what are consumers telling us they're expecting 6 months into the future?
6 months in the future, consumers are still very concerned about business conditions as well as the labor market and also their incomes. And it's interesting because incomes had been pretty buoyant in terms of expectations, but now they've weakened. And I think that's because consumers are becoming even more and more concerned about whether or not labor market conditions are going to be beneficial for them by mid 2026.
Now, inflation has been still rather sticky. How do we think consumers' inflation expectations have changed recently?
In January, consumer inflation expectations were split. So the average inflation expectations for the next over the 12 months from now, the average inflation expectations 12 months from now rose, but the median fell further and continues to decline. And so we're still having these outliers move the mean, but inflation expectations have been coming off. Nonetheless, they're still quite elevated relative to 2024 before tariffs came into play.
Okay, that makes sense. Now, what about stock market and interest rates?
In January, consumers' expectations for the stock market were slightly lower than December, but overall they're pretty high. And so consumers do believe that better days are coming, especially when it comes to equity markets. With respect to interest rates, we don't know what rates are particularly referring to, but they do think that interest rates may decline a bit relative to what they thought in December, but they still overall expect interest rates to be high. And that also makes sense given the fact that there have been structural changes in the economy that are keeping
Mhm.
prices elevated, and hence the Federal Reserve Board must keep rates higher than what we saw during the Great Financial Crisis and the pandemic. And so higher interest rates as the new norm actually makes sense. And I think consumers are picking up on that.
And so, with elevated prices, are consumers still citing inflation, politics, and tariffs as affecting the economy?
Yes, they are. In fact, prices and references to inflation and oil and gas and food and energy and groceries, all of those still remain very elevated and are the number one topics that people are writing in about. Yes, they're still writing about tariffs and trade and politics, but also we noticed that there were more comments about labor markets, and the context of these were actually negative. And we also did see an uptick in reference to health and insurance. So we're assuming that's healthcare and also war. Those two mentions rose a little bit over the course of January.
Okay. Now, are consumers anticipating a recession within the next 12 months in the survey?
We kind of have four measures for that. Those who are saying that a recession at some point over the next 12 months is somewhat likely edged downward, as did the share who said not likely. However, the share who said recession is very likely ticked back up, and the small percentage who say that we're already in recession already crept higher. So it seems while the bulk of the respondents say somewhat likely, the deltas suggest that some of those people who said not likely and somewhat likely fell into very likely and also we're already in a recession.
Now, in terms of buying plans, are there any notable trends for goods?
Consumers are more cautious about buying big ticket items over the next 6 months. And so those who are saying yes to buying big ticket items declined in January relative to December. And the percentage who said maybe rose.
Okay.
Those who said no was only slightly higher. So it's really people moving from yes to maybe. So they're questioning their
Right.
potential purchases. And just looking at the details here, expectations for purchasing new cars or just autos in general were flat. But when you split between new and used cars, people still prefer to buy used cars. And that thought about buying used cars continues to climb month after month, whereas plans to buy a new car just continues to dip. When it comes to home buying, we continue to see a retreat in those planning to purchase a home. And for things inside the home, like white goods, plans to purchase refrigerators, dishwashers, furniture, and TVs decreased. Meanwhile, plans for buying electronics dipped, which is a little bit surprising because people have been more affine towards buying these things. But the only thing that consumers are really willing to buy are electronics, are among electronics are smartphones. So the smartphone
Oh.
confidence continues to rise in terms of their desire. And I also may need to buy a smartphone because I just lost mine.
Oh, goodness.
But it's not an upgrade, it's just I don't have one,
A replacement.
a
Yes.
replacement. But overall, in general, consumers, despite the gyrations from month to month, they are still thinking about buying used cars, furniture, televisions, and smartphones.
Okay. All necessities to an extent. Yes. Now,
Ah.
yes. Are there notable trends for services?
Yes, for services, we asked, are they planning on spending more on services over the next 6 months? So it's a little different from goods.
Hmm.
So, but still, that was a little bit weaker in January relative to December, where those who said yes fell and those who said maybe increased. But those who said no is roughly unchanged. So the yeses, similar to goods, went to maybe for services also. But we're still seeing the same trends where consumers are leaning more towards buying goods and services that they need. And if they're going to do anything fun, they're exploring cheap thrills. So, for example, instead of going to the movies, I say this every month, but instead of going to the movies, they are still streaming. Streaming is number two in terms of the list of services
Right.
they plan to buy more of. Restaurants still is number one, but there were some pretty interesting changes in the order, the ranking. And usually I look at the top five. And in the top five, it continued to have restaurants and bars and takeout as number one. After that, streaming and internet, and also those two things remained in the top five. Consumers also said that they plan to spend more on motels and personal travel and motor vehicle services, as well as household maintenance, airfare, trains for personal travel. But there was a pretty big jump in those saying that they were going to focus on healthcare. So healthcare has been moving
Mm,
up the ranks. Like we have a chart splitting up roughly, I don't know, 20 different types of services. And healthcare was on page two. It's now jumped to page one, and it was third, it ranked third in January. So that's fascinating that there's this bigger focus on healthcare. And that's also understandable given questions around the high rising cost of healthcare and also in terms of public healthcare changes in policies. There was also an increase in those wanting to travel, which is interesting because when we ask people about vacation plans, those plans continue to dwindle. And we saw weakening in domestic travel, which is unusual because typically domestic travel has been pretty robust and people have not been looking to go abroad. So there's a little bit of a dichotomy here, but we'll see in 6 months.
absolutely. With that, we're going to take a short break and be right back with more of our conversation.
What does the future of work mean for your employees? How will your company navigate the future of AI? Will there be a global recession? At the Conference Board, our experts translate the latest research and economic analysis into insights and real-time problem solving for your organization. Membership at the Conference Board provides your team with an assortment of knowledge from economics, marketing and communications, governance and sustainability, public policy, and human capital. As a member, you'll have access to our center experts, member-exclusive events, data and benchmarking tools, and peer sharing that will help you understand the present and shape the future. Consider becoming a Conference Board member today by visiting www.conference-board.org.
Welcome back to C-Suite Perspectives. I'm Erin McLaughlin, Senior Economist of the Economy, Strategy, and Finance Center at the Conference Board. I'm joined by our Chief Economist, Dana Peterson. We're going to turn the tables a bit, and Dana is going to ask me some questions about recent trends in U.S. trade.
Yes, Erin, you are our trade czar. And so I'm going to pepper you on what's been happening over the last 6 months between the US and its major trading partners. So, how has trade been impacted over the last 12 months given tariffs and other trade barriers?
It's very interesting since we were just talking about electronics and products and how consumers are feeling. So, surprisingly, overall, even though this past year has been filled with a new tariff regime, we've seen US imports and exports go up overall. So, US imports are up 6.5% and exports are up 6% when we look at all US trade of goods going in and out of our country. But what's been really interesting is the changes that we have seen are pretty specific to a couple of our trading partners. And so our largest trading partner is Mexico, and we haven't seen that much difference in trade with them, but we've seen substantial changes in our trade with China, which is our second largest trading partner, and Canada, our third largest trading partner.
And so that's pretty much since Liberation Day. Can you give us a sense of how much of a delta we've seen between net trade or just exports and imports between
Yes.
Canada, the US, and China and the US?
Yes. So with China, our year over year difference, when we compare last year to the year before, we've seen a 26% decrease in imports and a 23% decrease in exports. And so it's been very interesting because that sort of mirrors the kinds of goods that we trade with China as have really declined. So those goods are in large part crude oil, heating oil, and other petroleum products, soybeans, which were in the news quite a bit last year. We ended up exporting 15% less soybeans last year than the year before, as well as sort of industrial machinery, appliances, and other things. That trade has been off. Now, what's interesting with China is that they're actually not very dependent upon US trade for their overall economy compared to Canada.
So Canada, okay, they're our next door
They're our
neighbors,
next door neighbor.
and as you said, there's been big deltas in terms of exports and
Right.
imports between the two economies. What do those numbers look like, and what have been the products?
So for Canada, our imports have gone down 5% and our exports have decreased 3%. So among our top 10 trading partners, only China and Canada are we negative with. Now for Canada, it's actually very similar, some of the goods, excluding soybeans, that we trade with them. So that's a lot of differential between energy products, including oil, as well as machinery and also automobiles. So our import and export of automobiles is off about 10% overall, and that is a big product that we trade with Canada. Now, what I think is really interesting is that obviously with Liberation Day and with sort of the tariffs that we've seen over the last year, we have pretty high tariffs with China. They really range anywhere between 10 and 45%. But with Canada, we only have tariffs on about 13% of our goods that we're trading with them. More than 80% of our goods are covered under USMCA. So the fact that we're in a decline really speaks to not so much the tariffs having an impact as much as maybe behavior, policy, and just a general cooling in the relationship between the two countries.
Fascinating and shocking.
Yeah.
So, remind us of what our current truce is with China and how long it will last regarding trade.
Yeah. So I know over the last year, and obviously we just saw this in our discussion around consumer confidence, uncertainty is still really paramount for consumers, for businesses. And I think in 2026, we're going to continue to see uncertainty be really high because our sort of trade and tariff is not settled. We seem to have settled things when in this past November, we have a quote unquote truce with China, but that truce only lasts until November of next year. And so we're going to have to re engage with China over
Is that
trade
November 2027 or 26?
26. So we
Okay, so
have
that's this year.
this year, from November of last year coming up until this November, is our quote unquote truce with China. And then with Canada and Mexico, we have the US Mexico Canada trade agreement, which is essentially up for renegotiation leading up to July of this year of 2026. So I think we're going to continue to see persistent uncertainty with our three big trading partners all throughout the next year.
So, final question. What are some signposts that our members and listeners should pay attention to regarding whether or not we're going to continue to have or improve our relationships with China, our relationship with China, and also what does it mean as we renegotiate, the US renegotiates USMCA with Canada and Mexico?
I think they're all combined, and we've really seen that within the last couple of weeks. So when the Canadian Prime Minister Mark Carney spoke at Davos recently, he really talked about the reordering of global trade. And Canada had been meeting with China over the last few weeks, and there was a sense that perhaps Canada maybe sort of agreeing to more free trade with China and turning its back a little bit on the US. And the administration's reaction to that was pretty strong. And so just within the last couple of days, Canada has come out and said that they would not be doing a big free trade agreement with China. And we've also seen with our US and Mexico relationship that China, quote unquote, enters the chat. And so Mexico has put their own tariffs on Chinese goods. So I think that it's not really necessarily just about North America. The impact on China, the impact that our two big trading partners that are our neighbors have with their relationships with China are all going to be part of the trade conversation as we work through this coming 2026 year.
This year is certainly not going to be boring.
No.
Thanks so much, Erin. This was a great conversation with you interviewing me and then me interviewing you.
Yes.
So thanks for coming.
Thank you for having me.
Absolutely. And thanks to all of you for listening to C-Suite Perspectives. I'm Dana Peterson, and this series has been brought to you by the Conference Board.
You have been listening to C-Suite Perspectives, a podcast by the Conference Board.